Hello, good people. Emmanuel Safali bringing you the Promise Insurance Show. And this time around, I also talk about life insurance. In the past, I've made a segment on life insurance. I talked about the Somesa, the Sure Deal, the endowment policies that are available on the market. And I got some feedback that I used very high figures. They are out of range of some of us. And this time around, I want to make a repeat, something that is affordable, down to the level of Omuntu Wawansi, so that you gain the appreciation of why it was designed this way. And why life assurance? I hope some of you have listened in or know the word, the acronym VUCA. That is V for volatility, meaning we're living in times where things are changing so rapidly. Just now, they are closing schools very early because of Ebola. We've just come from COVID. All that shows you that we're in the times of volatile times. That's VUCA for V. And then U, we are living in uncertain times. There's a lot of uncertainty dwelling around us. So how do we respond to it? How do we, be productive around it? Then there is the C element, that is complexity. The world is just complex as it is, right from birth to death. They say that we are born from B to D. Now, between the B and D, there is C. That is the choice you make, and then around the whole complexity of life. So you can choose the bitter or the better. The better side. There are always two sides of the coin. And now that's a reason you have to make a choice. Life insurance or not. Do you choose the bitter side of life or the better side of life? Then lastly, ambiguity. Ambiguity is living in things that just don't make sense. Once you know this product really and what it can do for you, I really don't know what you will be waiting for to sign up. So with this free intro remarks, let's start with the most common product, the product that is actually taking on the most clientele. That is the education policy, what you call the children's education plan. It's not going to cover you, it's not going to cover the child, but it's going to cover you, the parent, but for the benefit of the child, should anything happen to that child and the parent. So let's look at how it works. There's a lot of technicalities, but I'm going to try to make it simple for you. Then we shall also look at another package, and then let's look at that and then we get back to you. Thank you. Today we have mentioned this VUCA element, that is, it stands for volatility, uncertainty, complexity, and you see this diagram. Life is generally like that. Of course, it's volatile. We are seeing money changes, and also anything is changing. Then we see uncertainty, and there is a lot of uncertainty in the discussion of life insurance as we know it today. We look at complexity. It is kind of complex. People have mentioned how insurers are complicated people, and we make things complicated. Then we also look at ambiguity. But we also know that if you Google how volatility VUCA is being responded to, there is vision. You must have a vision to respond to this volatility issue. You must have a vision, a clear vision. So when you talk about life insurance, you must really have a vision of what you want to invest or save for, because life insurance has three elements. It has saving, investments, and then life insurance. You're covering. But now, what is that dream that you have that you want to set out for and start planning? And then we shall also look at the elements of how it can be done. So let's look at volatility and then the vision. Then uncertainty. How do you respond to uncertainty? We have to understand, and that is what we're going to do today. We want to understand how the life insurances, the common ones, for instance, here in Uganda and East Africa, work. And let's look at also the complexity. Generally, life insurance or insurance generally has been a complex subject. It's an abstract subject, so we want to make it easier for you. And that means we have to clarify. We have to seek clarity. So that is the solution for the complexity bit. Then the ambiguity, we have to look at the agility. You know, ambiguous things, they are not special, well laid out plans. So we have to be agile and look at the agility bit as a leader in any enterprise or business or any walk of life. Now, in Uganda, we have seen that majority of the policies that are talked about are called endowment policies. Actually, they're endowment in their nature. And now, what is endowment? Endowment is, if you look at a simple Google search, an endowment is a donation of money or property to a non-profit organization which uses the resulting investment income for a specific purpose. So generally, that is what Google will tell you when you talk about an endowment, because that is where the majority of the policies in Uganda fall into this. So today, I would want to start with the package that we call the SOMESA Education Plan. And this time it's brought to you by Old Mutual, UAP Old Mutual. This has been ongoing, and maybe we are reaching out to the owners of the brand to give us access to present this to the marketplace. Now, how does this product look like? Remember, we talked about credit at the time. Now let's talk about how a life insurance would work. It can start anywhere. So let's say these are age-based because you are safeguarding your plan. Now, if it was meant for the children's education, you know, just like we talked about this endowment, how the seed grows from being planted in the ground. Remember, they talked about something that you're saving for to support a future cause. So when you plant this seed, how is it going to grow? Sprout up into a small seedling, then grow over that. It will take some time, definitely, to grow. So it could be these months, but in education purposes, it will take some bit of years to plan and set up a good fund that will take care of the children's education amidst the VUCA element that we have discussed. Yeah. So we need to have a vision, and this is usually the long-term vision that we have in mind. We have to understand the process of how our monies, the monies we are saving and investing, are growing, and what are the complexities around. We need to clarify that, such that should anything happen, you know where to run to. Then ambiguity, agile. How flexible are these policies? Should anything happen to you 1 year down the road, 2 years down the road, what happens should you fail to meet up your daily obligations? So let's go back and hear what UAP is going to offer for us. So let's look at an example. Remember, last time we used someone aged, let's say, 1st of February 1987, because the same example we used last time. And let's have a goal worth, say, 100 million. And that was to safeguard this parent who is in their 30s, mid-30s, actually they're 36 as of the year 2022. And let's say they are taking out a plan of 10 years. They're male, it could be female, whatever the sex, that is now for the parent, because you are the parent who is going to be safeguarded for your estate or your endowment goal of children's education worth 100 million. Now, there's an element of paying monthly. Let's start with the monthly element, because we know many people are salaried, so you earn monthly salary. Then you shall also see for an element where you can get a discount on an annual basis, or if you're saving quarterly. So let's payout period. Usually this is now upon maturity. After these 10 years of saving, this 10 million, this child possibly was a young child in primary, maybe primary 2, primary 5, has spent 10 years to reach university. Now, university plan or any plan for that matter will take also some time. Let's say a 3-year course, a 5-year course. Let's say 3-year course, so that it's paid out on a annual basis, you know. So with that, beneficiary is not so important, but again, let's look at how much this is going to go into. This is going to show you how much this person is going to be paid. So remember, we talked about a value of 100 million. The premium for this person in year 36 will be 574,000 for the main package, which is to pay out the 100 million at the end of the 10 years. Then there's a waiver of premium. This is on disability. It's also covered for. There's a small premium additional of 28,000, which is to take care of disability. In case you, the parent, get disabled, but for the benefit of the child, the policy will still remain in force. The insurance company, in this case UAP or Mutual, will have to pay these premiums on your behalf to the insurance company. And all this premium of 686,000 at the end of the year, it will be paying it out up to the time you recover. That is in case you're incapacitated. Then there's the child income benefit. This is very special. I know many competitors are out there, but since Old Mutual has been the first one to come out, possibly it will also be a good thing to do your research and know that you're actually going to get something really worth it. Now, this is the child income benefit. This actually pays out quite some significant amount of about 12% of the value. So if the value here is 100 million, this will be paid out 12 million on a yearly basis. Should anything happen to you as a parent and you pass away, let's say, in the worst case area. Let's look at the, okay, maybe let me explain this last benefit. Is that life cover. This is a death benefit. It is like Mavugo. This is usually 10% of the value here of the sum insured. So this is 10 million. This is paid out in 48 hours upon presenting death certificate or any proof of death, you know, from the LC. This will be paid out immediately to take care of the funeral expenses, about 10 million. And then as you process these other benefits, like the child income benefit. Now the total premium would be 686,000, yeah, which is something significant. But remember, the insurance company is also investing these monies. So let's look at how much it would be. You would have contributed. Let's say worst case scenario. Okay, not worst case. Let's look at this value times 12 months will be 8.2 million. So within 10 years, you would have contributed 82 million. But remember, you're being guaranteed 100 million. Actually, 100 million plus. Let's look at how much, if you compute upon maturity. Remember, we talked about a payout period that upon maturity will be paid out at the end of the 10 years accumulation phase in installments of 34.6 million over 3 years. So what is this 34 million? You're looking at, let's clear this. So this is 34,648,89. That's so times 3. So actually the actual payout period at the end of the 3 years will be that. And then if you subtract this from the 82 millions, 82.4, you can just round it up to 82.4. So you'll be having a good return of about 21.5 million. Yeah. So that is upon maturity. Now let's look at also the worst case scenario, that you have paid out 1 year, that is about 8.2 millions at the end of the year, and God forbid death strikes. This is where the child income benefit will come in to pay 12 million every year for the next 9 years. So 12 million times 9 years
is 108 millions. Then on top of this, they still have to pay 100 million upon maturity, that making it 208 millions. So that is a very good benefit that helps you have a good firm foundation. And as remember, we had a discussion with Old Mutual with the presentation they made with Post Bank. They showed you that indeed they have been able to pay people even 1 billion plus, of these income benefits. Why? Because they're taking out this kind of package. So this is what it means to have an estate planned out for you. So, and this is quite a very good benefit. And if you are to compare with what is on the market today, this is something that will be good. And that is why we have brought.
All right, welcome back from that explanation. I hope you have understood something about the SOMESA or the Children's Education Plan. Now let's look at another alternative for those who don't have, or you don't want to plan for the children, or you're not having children yet, but you have a dream you want to achieve, you aspire to. You set a time, a value on it, and for how long you want to invest for. Let's work out a value, an example of about 10 years. We can use between 5 to 10 years, but let's use whatever example we are going to use in the details. And then you see what is the value, what is in it for you at the end of the day. Should you survive throughout those whole 10 years? And should nothing happen within those 10 years, what is in it for you? How much return are you getting back at the end of the day? So tune in and listen to this rest of the segment. Thank you.
This is now the Sure Deal investment plan. Remember, we had now the children. Now, in case you don't have children, but you just have a plan, it could be any goal that you have. We have seen people building various houses. Remember, we have also talked about this end vision that you want to look at. But you remember, you're starting somewhere. You have to set out time frame, and you attach it, give it a value. Let's say 100 million is the value. Remember, the date of birth that we used the other time was 1st of February 1987. And then again, we're using a 10-year plan. We're just going to compare because it's between 5 to 10 years. And let's maintain the male, since last time we used still male. Now, if the premium is still the monthly, this time around I'm going to show you the element if we are to use annual premium and also quarterly. But let's start with the monthly one because we know many people are salaried. And now for whatever goal this person had of worth 100 million, we're going to see how much it's going to grow. Now, for this same plan of 100 million, there are other embedded benefits like the life cover. Remember, this is what we told you was the Mavugo, 10 million, 10%. That is very self-explanatory. This is paid out in 24 hours. The main benefit is paid out at the end of the 10 years, remember, but for it, you're accumulating 500,000 on a monthly basis. Yeah? So, such that you can maintain a good plan. But remember, it's also safeguarding you should anything happen. Even though you have only paid for 1 year or 1 month and death strikes, the insurance company is liable to pay 100 million to your family members to ensure that your dream or your legacy keeps alive. So the life cover is Mavugo. You're only contributing 8,000 to it, and that means and this one is paid out in 48 hours. We also look at the disability cover of 5 million, which is 5% of the main benefit. This is in case you are incapacitated, they pay you 5 million, just on top of your medical insurance in case you have, to help you get back on track. Accidental cover, that is 10 million, that is 10%. So in case you are incapacitated and you're disabled, we shall pay twice. Then we shall also look at waiver of premium. This is on disability. Again, we explained the disability element. In case you are disabled and our doctors say so, we shall stop you from paying your premium and we pay it on your behalf. Now for that, the premium would be 617,000 compared to the other one, which was 640 something thousand, such that you will find that you're contributing 373 times 12 months. So that means in 10 years you would have contributed 74 millions. If you look at how much you deduct from the 100 million, you'll find that you will have a return of about 25 million. And because there's an investment element for it, so which is something still good at the end of the day. Yeah. So let's look at if you are to save on a yearly basis, annual basis. Remember here you have been saving about 74 million. On an annual basis, you will find that you're actually contributing, there will be a discount of sorts. That means you have contributed 7,026,000. If you multiply that by 10 years, you would have contributed 70 millions and 20 something thousand, meaning there will be a return of about 30 millions. So if you compare that with the other one, you'll find here you have a better dream, and also a better return, but of course the risks are lower. There are no other, like the child income benefit that we explained in the children's plan, it won't be there. So this one would also help you to have a good plan, but it has less benefits, because the exposure in this case is just 100 million compared to the other one, which had exposure was about 208 million should anything happen to you in the first year. Meaning here, should anything happen to you in the first year, would pay out the mabugo, and you wait for the whole 10 years and we pay the full 100 million. Now, with that in having been said and done, what are the drawbacks? Of course, we know saving is a challenge to many Ugandans. Now, should anything happen to you, this policy allows that you should have saved up for at least 3 years for you to pull out of this plan, whether for the education plan or for the sure deal plan. So please maintain the endowment element. Like nature, like plants, there is nothing, once you stop watering the seed, it will die. So your dream shouldn't die once you stop paying premiums. There is no way around it. But we understand that there are so many circumstances, and for this plan, as you have seen, the returns that are within are embedded from the investments that have been made at Nakawa Business Park. This is Nakawa Business Park. This is the headquarters of UAP Oil Mutual in Uganda. So for this plan, this is part of the investment of the clients of the life insurances, such that whatever your plan has an embedded element of the investments, and that is how it is only possible for it to be done. So with that said and done, please remember to keep the discipline as you go ahead with this kind of plans.
So thank you for keeping tuned in this far. We started this program with the VUCA element, or the VUCA times we're in. That is VUCA standing for volatility. We're looking at uncertainty, we're looking at complexity and ambiguity of life today as it is. And no matter all those situations that are around us, that are surrounding us on a daily basis, we're living in an ocean of risk. Every time we step out of the home, there are so many things that can happen to us. So if you want to safeguard all that happening, and you want to maintain life, and even when we looked at the history of insurance, life insurance was like the core, that was the beginning of insurance. If you really want to take out a package that will first of all benefit you in terms of savings, having more value for money, in terms of the return that you will get, if you're looking at safeguarding your lifestyle and your children's future education and lifestyle, this was the program for you, and I hope you are going to reach out and also recommend it to your many other colleagues and friends. Please share it as much as possible. I also remind you to subscribe to the channel and send us your feedback tell us any concerns. Have you had any challenges with any insurers who are not who are not meeting the promise they made out to you when they were starting these policies, when they are reaching out to you? Tell us, we want to hear that feedback so that you reach out to those stakeholders. We shall bring them on air so that they can give you the heads up on what they need to do better. They need to hear from you so that we can all be at an equal footing. Because many times there are so many people marketing, but many times what is actually on paper is different. So, till next time, I'm Emmanuel Sani Safali, reminding you to hope for the best while preparing for the worst. Thank you. Ciao.